Hello and welcome to our workshop today on Cash Flow Secrets. I'm Paul Hoyt, your host. As we get started, we'd like to thank our sponsors: Comcast, the City of San Jose, PG&E, International Line Builders, the California Department of General Services, AT&T, the California Water Association, and the nationwide network of Elite SDVOSB. First, a little housekeeping. You should have an Excel spreadsheet to complete at the end of the workshop today. When you signed up, you should have gotten the link that allowed you to download that. If you have any problems, please send us an email and we'll send you one right away. And we're going to answer some questions at the end of the workshop. In most of our workshops, we pause in the middle to have some questions and then pause again at the end for questions. But in today's workshop, the material just kind of flows through the entire presentation, so we will not be taking a break in the middle. This presentation is based on the Awakened CEO system, which is a balanced and comprehensive approach to business growth on multiple levels. In the Awakened CEO system, we talk about the importance of being competent and even excellent in several different areas of business: leadership, sales, service and delivery, marketing, product development, operations administration, and financial management. And today's presentation is all focused on the area of financial management. In today's presentation, we're going to talk about the importance of cash, the cash flow statement, sources of cash and uses of cash. We're going to talk about forecasting cash flow, tips to increasing cash flow, and then sum it all up with the bottom line and next steps. So let's jump right in and talk about the importance of cash. I don't think it's possible to overstate the importance of cash in your business. I know you've heard the expression that cash is king, but I think it's even more important than that. I think that cash is, in fact, the lifeblood of your company. I don't mean to be morbid here, but if you had an accident and were severely injured and were bleeding out, you could actually die from not having enough blood in your body. And likewise, your company, your business can die when you run out of cash in your business. I like to think of it as the energy flow of your company too. There's tremendous energy that comes into the business when cash is flowing into your business. It creates all kinds of possibilities and opportunities, and you can run out of cash while making a paper profit. We'll talk a lot more about that in a few minutes. When we produce financial statements for a company, there are three types of financial statements that are commonly produced. First of all, the profit and loss statement, which is also called the income statement. Then the balance sheet, which takes a little more financial acumen to understand, and the cash flow statement, which is the most sophisticated and I think in many ways the most important of all. Whenever I create investor-grade financial projections for clients, we produce all three of those statements month by month and then year by year, because it's the only way to really project the true cash requirements of your business. And what we find is that producing the cash flow statement on a month-by-month basis oftentimes results in changing the growth strategy, the funding strategy of the business, and sometimes the entire business model. As it turns out, there are two different common forms of the cash flow statement. The first one we'll call cash flow statement number 1, shares the net income. Then it talks about and shows adjustments to cash from operations, and shows adjustments to cash from investing activities, and shows adjustments to cash from financing activities, and sums it all up to the bottom line to show what the net increase or decrease in cash was for the month. This is my favorite kind of cash flow statement because it shows very dramatically how different areas of the business can either contribute to cash or can consume the cash of the business. But there's another form of cash flow statement that is very common as well, and that is number 2, which starts out with the beginning balance of cash. We add the sources of funds and subtract the uses of funds, which shows us the ending balance of cash. Here's an example of what cash flow statement number 2 looks like. As you can see at the top, we have the beginning balance in the orange squares. Then we have sources of funds like cash sales, collections, loan proceeds, and investors. And then uses of funds such as direct cost, office expenses, product development, and debt service, which gives us an opportunity to calculate or project the cash at the end of the month. We're going to come back to this in a while, but for now let's talk about cash flow statement number 1, where we start with the net income and then we make adjustments based on the activities that we have in various areas of business. We're going to take those areas of business one by one. First is the net income. The net income contributes to cash with a profit, and that makes sense. If we run a profit in our business, we should have more cash at the end of the month than we had at the beginning of the month. And likewise, that if we had a loss for the month, we would expect to have less cash in the business at the end of the month than we did at the beginning of the month, usually, but not always, because there are other things that take place that consume cash or contribute to cash that impact whether or not we have more cash at the end of the month if we made a profit or a loss. So let's talk about those. There are a lot of different things that we do in the normal operations of business that will make adjustments to our cash balance. For example, if we increase our accounts receivable, it reduces the cash that we have available, and likewise, if we decrease our accounts receivable, it provides cash and increases the cash available for the business. And I think this makes sense. If I sell $5,000 worth of merchandise, but I don't get the cash for that money today, let's say that we take $2,000 down and we give our customer terms so that they can pay us $1,000 a month for the next 3 or 4 months, then we didn't get all $5,000 in cash this month. We only got a couple of thousand of it. So this month, as we increased our accounts receivable, we decreased the cash available to us, and in subsequent months, as we paid off the accounts receivable, we increased the cash that was available to us. Another adjustment may be depreciation and amortization. Tax laws require us to depreciate some assets of the business. In other words, if you go out and buy a car, you're not able to deduct the entire cost of that car from the business expenses this year because tax laws say that you have to capitalize that asset and then depreciate it over time. So depreciation expense subtracts from the net income, but it really didn't consume cash. The same with amortization. And the difference between depreciation and amortization is that we depreciate physical assets and we amortize intangible assets. So if we have startup expenses or we have some goodwill that came to us when we purchased a business, we amortize that over time because it's not something that we can really sell. It's not a fixed asset. It's an intangible asset of the business. We also make adjustments to cash from operations of the business if we increase our inventory because that consumes cash, or decrease our inventory, which provides cash. And I think this makes sense too. If we need to pay $10,000 to a company in China to ship us our products, that $10,000 consumes the cash of the company by increasing our inventory. And likewise, as we sell that inventory off, it provides cash because we didn't have to pay the money directly in that month whenever we sold that product. Increases in accounts payable also provide cash, and decreases in accounts payable consume cash. So if I buy something on credit or I buy something from a supplier and I don't pay him until next month, then that cash didn't come out of my pocket this month. Likewise, if I pay down accounts payable because I owed somebody some money, then that consumes my cash this month instead of the month in which I actually incurred the debt. Investing activities can also consume cash or provide cash. Increases in fixed assets and other assets consume cash. So when we buy furniture and fixtures, when we buy trucks and automobiles, when we buy buildings and land, it takes cash out of the company's bank account, but it doesn't have an impact on the income statement. And likewise, if we were to sell off some of those assets, we would have more cash than we had at the beginning of the month. If we decided that we really didn't like that couch that was in the lobby of our building and we sold it to one of our employees for $50, we'd have $50 more in cash than we had at the beginning of the month. Also, increases in capitalized development expenses consume cash. So if some of our employees are working on some R&D efforts, or if we're hiring an outside engineering firm to develop some new products and services for us, those type of expenses don't directly impact the income statement of the business, but they do have an impact on cash. We have to capitalize those as an intangible asset and then amortize them over time. Financing activities can also contribute to the cash available to the business or take away from that cash that's available. Increases in interest payable provide cash, and decreases consume cash, and increases in notes payable provide cash while decreases consume cash. So what that means is when we borrow money, we have more cash than we did if we didn't borrow the money. We've increased our notes payable and we've increased our cash. And as we pay down that debt, as we make those payments against the principal and interest for the money that we borrowed, that reduces our cash in the following months. And finally, increases in investments into the company provide cash, and decreases consume cash. By the way, decreases are fairly rare, but occasionally a company will decide that they're going to buy back some of the equity that they've previously sold to investors. So cash flow statement number 1 allows us to take a look at the cash activities in the business by various areas in the business. We take a look at net income, and then we make adjustments to the cash provided by the profitability of the company based on the things that we covered earlier. So that's how we use cash flow statement format number 1. We start with the net income, then we either analyze or we project adjustments to cash from our investing activities and from our financing activities to come up and understand what our net increases and decreases in cash have been during the month from all of those different areas of the business. Now let's take a look at cash flow statement format number 2. And here we're going to go through some very specific examples, which I think makes it even easier to understand how cash flows in and out of the business. So this is a sample business that starts out with $5,000 in cash as a beginning balance. If they didn't do any business at all, if they had no income and no expenses, they would have $5,000 at the beginning of the next 3 months and at the end of the next 3 months as well. But since they are in business, they're going to have some sources of cash. They may sell their products and services for cash. They may collect on accounts receivable. They may increase their accounts payable, which is to say that they're not going to pay their suppliers this month, but rather defer it till the next month. They may sell some assets, such as their inventory, vehicles, or even accounts receivables. And yes, you can sell accounts receivables. There are companies out there that will factor both purchase orders and accounts receivable. So if you've done business with a major supplier that has an extremely good credit rating and they owe you $100,000, you may be able to sell that $100,000 accounts receivable for $80,000 or even $90,000 to somebody who's in the business of purchasing receivables. You can also receive investments in the business, such as somebody deciding to buy an equity position in your business in return for cash, and you can borrow money. All of these things will provide cash to your business. They are sources of cash to the business. But likewise, there are things that we do in business that consume our cash. Direct costs and cost of goods sold, such as paying for the products and services that you sell, and commissions and royalties and merchant account fees. What I find is that when most companies do cash flow projections, they oftentimes don't remember things like royalties and commissions and merchant account fees, which can take away 15-20% of all of the cash that you generate for the business from your sales of your products and services. Increasing our accounts receivable, giving our customers terms, also consumes cash or uses cash, because we're essentially saying, don't give me the cash today, you are welcome to give me the cash tomorrow or next month. Other uses of cash include current operating expenses like payroll and marketing and insurance and rent, or prepaying expenses where we've decided to take advantage of an opportunity to prepay one of our suppliers, making down payments in deposits on merchandise and fixed assets that we may want to purchase. Decreasing our accounts payable by paying off the suppliers that we owe. Purchasing assets, as we covered earlier, fixed assets for the company. And paying off long-term debt, all use cash, as does buying back equity. But my favorite use of cash at all is distributing profits to the owners of the business. I mean, that's why we're in business, is to generate a profit and then eventually distributing those profits back to the owners of the business. Whenever we forecast cash resources, we usually do it in this way. First of all, we forecast cash sales by customer, territory, product line, whichever way is most convenient for the business. Then we talk about the ability we have to collect on our accounts receivable. We talk about the ability we have to finance some of the purchases that we make from our suppliers, any opportunities we might have to sell off assets of the company, and any plans we might have to borrow money for the company. And finally, forecast any sort of investments that we may expect into the company. And so when we forecast cash usage, we talk about the cost of goods sold and the direct costs that we have, the operating expenses that we have, many of them recurring month to month, some of them periodic like quarterly tax payments. And we also try to forecast unplanned expenses too. We'll talk about that in a few minutes when we talk about some of those nasty cash flow surprises. We forecast any sort of product development efforts that we might have, R&D efforts, and any debt service that we might have to pay off credit cards, accounts payable, or notes payable. Now let's go through some specific examples of doing that using cash flow statement 2. So as we discussed earlier, this is where the business starts, with a beginning balance of cash in each of the next 3 months and the same amount of cash as the ending balance in cash. In month 1, they sell $5,000 worth of merchandise and they collect $2,500 on accounts receivable, giving them a total sources of cash of $7,500. They also had some expenses, though expenses were $4,000 in direct costs, which means that they had a very low gross margin. They sold $5,000 worth, but it cost them $4,000 to deliver those products and services. They have normal recurring office expenses of $2,000 a month. They decided to invest $4,000 in product development and pay off some debt for another $500, giving them $10,500 in uses of cash, which left them for cash at the end of the month of $2,000. They started off with $5,000. They brought in $7,500, giving them $12,500. They used $10,500, giving them an end-of-month balance of $2,000. In month 2, they started off with $2,000. They had cash sales of $6,000. Again, they collected on some old accounts receivable debt, so they had another $2,500. But they decided that that cash balance was too low, so they borrowed $5,000 worth of cash, giving them a total of $13,500 in sources of funds. That month, they only had $3,000 in direct costs because the services that they provide or the products that they sold had a much higher gross margin than they did in the previous month. They had $2,000 worth of recurring office expenses, $500 worth of debt service. So this month, instead of using $10,500 in cash, they only used $5,500 in cash, leaving them with $10,000 in cash at the end of the month. And in month 3, they sold $5,000 in cash sales. They didn't collect in on any more debt, and they didn't borrow any more money, so that was the only cash coming into the business was the $5,000. They had direct costs the same as they had in month 1 of $4,000, the same recurring $2,000 a month in office expenses. This time they decided to invest $3,000 in product development and pay a little extra out in debt service, meaning that they used $10,000 worth of funds, leaving them at the end of the month with $5,000, which, by the way, is exactly where they started 3 months ago at the beginning of month 1. But what a journey they have had. The cash has come in and the cash has gone out in interesting ways. Depending upon the timing of when they sold in month 2, They might have actually had to pay off some of those direct costs or pay off some of that debt service before they got the money from the bank, before they collected on the accounts receivable. And their money could have gone from $5,000 all the way down to zero, maybe as high as $15,500 in cash, and then finally at the end of month 3, back to $5,000. And that's the way that cash comes in and out of the business. It's only the largest businesses that have dozens or hundreds or thousands and thousands of customers giving them very predictable cash flow that really don't suffer the ups and downs in cash as most small businesses do. So most small businesses need to prepare for the common ups and downs in cash, and they also need to prepare for what I call nasty surprises. And unfortunately, every small business has nasty surprises from time to time. Here's a sample of some of them. First of all, deals that fall through. You thought that you were going to get that deal, you thought you were going to get the down payment or the entire payment, but it just didn't happen. So your cash is not nearly as high as you thought that it's going to be. Or worse, you sell the deal, but then somebody's check bounce, or a credit card payment won't go through because they gave you the wrong credit card, or the credit card was declined. Or worse, customers that don't pay you at all. They said they were going to pay you, but then they don't end up paying you, and so you have to write it off as bad debt expense. Employees leaving the business always cost you in cash. They cost you in terms of vacation pay that you have to pay out immediately. You might have to pay a recruiter's fee. You might have to pay overtime. They might have to pay all kinds of different things like outsourced expenses in order to compensate for the lack of services that you had from the employees that have left your business. Suppliers occasionally will have price increases that were unexpected that cause you to lose cash more rapidly than you thought that you were going to. Or you might have some equipment that needs repair or replacement. And one of my least favorite of all is tax liabilities, where you get a little piece of paper in the mail that says, "We've been taking a look at your tax returns and we decided that you owe us more money than you thought that you did, so please pay up right away." But wait, there's more. Other nasty surprises might be suppliers who don't deliver. You've paid the supplier a down payment or even complete payment, but then they just don't deliver on the product at all. I actually had one customer whose products were on a boat that the boat got swamped and sunk at sea. And then the supplier went bankrupt. So they were out all of the money that they had paid to the supplier with no recourse except for to perhaps file it on insurance. Unexpected travel expenses can consume cash, where you discover that you really do have to jump on an airplane and go across the country or across the world in order to take care of some business that can only be taken care of face to face. Every once in a while we have impulse purchases where somebody just decided to buy something for the business without taking a look at the bank balance or to even check to see whether or not it was a budgeted expense. Marketing investments that don't work are a very common nasty surprise, where we invest a lot of money into an advertising campaign and it just doesn't pay off. It just doesn't give us the revenues that we expected on the other side. R&D setbacks are very common, where we thought something was going to cost $30,000 to create, but it ends up costing $50,000, $60,000, or $70,000 to create. And Murphy's Law really got to us, that it did really take twice as long and cost twice as much to create something as we thought that it was going to. We can have economic and competitive pressures. If a competitor decides that they're going to try to drive us out of business by lowering their prices significantly, in many cases we have to match it, perhaps not entirely, but at least a little bit, in order to stay in business. And finally, legislation. Every once in a while, the government decides to pass some laws that either say that we have to do something more, that we have to expend more by doing quality control tests or some other certification process, or they'll pass a law that increases taxes on whatever it is that we're either purchasing or selling. But here are some general tips that you can use in order to really improve your cash flow situation. In general, we improve our cash flow whenever we increase sales, whenever we cut expenses, and improve profitability of the business. So it's important for you to analyze your business to discover which departments, products, marketing campaigns, customers, locations, etc. are consuming cash and which ones are generating the most cash, so that you can make adjustments to the operations of your business to improve the cash flow of your business. You may have to outsource to reduce overhead because it's always easy to delay contractual expenses than it is to delay expenses to people who actually work for you. Here's some more general tips. You may want to reduce the cash outlays that don't directly increase profitability, such as accounts receivable. Stop giving people terms. Stop purchasing fixed assets. Try to get by with lower amounts of inventory. And you always want to borrow wisely and manage your debt carefully. So you may want to pay off the debt that has the highest interest rates to it, and you may be very careful about when and where you borrow the money. Here's some more specific tips. First of all, always require down payments from customers. Never get yourself in a situation where you've provided a product or service to a customer, especially if it's a significant dollar amount, but they haven't paid you something down on the products or services that you're going to provide. And oftentimes it's important to require final payments before shipping the final product. This has a lot to do with the class of customer that you have, but generally, if you're providing products and services to small businesses, it's really important to require final payments before shipping the final product. If you're doing business with very large businesses who have very steady cash flow and great credit ratings, that's not so important. Accepting credit card payments will cost you around 3% of the revenues, but you'll get the cash in the next 2 or 3 days, so that can be a very important way to increase the cash flow of your business. We can also offer discounts for advanced purchases. So we can tell a customer that if they want to purchase 3 months worth of supplies now, that we can give them a discount on those for a volume purchase discount. And we can offer discounts for rapid payments. I don't know if you've ever heard of payment terms such as 2% 10 net 30, but what that means is if you'll pay me within 10 days, you can take 2% off of the bill that I just sent you, or you can wait until the end of 30 days and pay the bill in full. So offering discounts for people who will pay you more rapidly than normal can also be a way of increasing cash flows. Other specific tips include making collection calls. Yes, and that's really a mindset issue, that you do have to pick up the phone and call the people that owe you money and ask for them to pay you that money. What I find really works for me is to offer them to pay it off over a series of months. Say, will you pay me $500 a month for the next several months? You don't have to pay the whole thing now, but if you pay me $500 a month for a while, we're both going to feel a lot better about that. And a big tip is making pre-collection calls. When somebody owes you a significant amount of money, you can pick up the phone and say, hey, we have a payment that's due to us next week. Is there anything that's going to prevent you from making that payment on time? And when you talk to the accounts payable department about that, they may actually go ahead and write you the check today just because you called to make sure that they were going to write you a check tomorrow. Leasing instead of purchasing can be a very good option because typically with purchases, you have a greater down payment than you do with leases. And you may get consignment inventory. Walmart and other large companies actually make a tremendous amount of money because they never pay for the inventory until they've actually sold the products. Essentially with Walmart, almost all of their inventory is consignment inventory because of the terms that they have with their suppliers. And then deferred or installment payments to suppliers can really help too. When you say, I would like for you to ship me the product today, but I can't pay you for the next 90 days or so. And here's a few more tips. First, produce and study the cash flow statement every month and talk to your CFO or other financial advisors about how you can do better to manage your cash flow and build up a cash reserve. There's nothing quite like having 3 or 4 months worth of operating expenses on hand in the form of cash reserves to make you feel good about your business. And here's the bottom line. You really do have to be good at managing cash or you're going to be in big trouble in your business. We talked about cash being the lifeblood of the business, and that's true. There are a few things that you have to be good at in order to stay in business. You have to be good at sales, you have to be good at delivering a quality product or service, and you have to be good at managing your cash. Please understand that you're going to have nasty surprises and hopefully an occasional windfall where somebody just decides to pay you in advance even when you didn't ask for that. So make sure that you have plenty of cash and credit available to weather the ups and downs of business. That's been our agenda for today. We talked about the importance of cash. We talked about the cash flow statement, sources of cash, uses of cash, forecasting cash. We provided a lot of tips to increasing the cash flow in your business and summed it all up with the bottom line. And here's some next steps for you. Download the cash flow template and the sample financial projections we have provided. Create your own cash flow forecast for the next 90 days or so, and then check your accuracy by seeing how much cash you actually have at the end of each month. It's very common to have plus or minus 20% in your cash flow forecast because that's just the way that business works. If you have any challenges with cash, please get coaching or consulting to help you. We here at VetHelpVet are eager to support you in the ways that we can to help you analyze your cash flow profile, create financial forecasts, make good decisions about improving your cash flow, and then actually implementing those decisions. We're going to take a couple of questions here in a minute, but before we do, we'd like to give some additional thanks to our sponsors, Comcast, the City of San Jose, PG&E, International Line Builders, the California Department of General Services, AT&T, the California Water Association, and the nationwide network of elite SDVOB. That's been our presentation on cash flow secrets. Let's take a couple of questions here and see if we can't add a little more insight to those who are listening today. We have 2 or 3 that have come in as we've been doing this presentation. Here's the first question is, do I really need a cash reserve? Can't I just use a line of credit? And the answer is, yeah, you can just use a line of credit, and I've seen businesses do that, but lines of credit always cost you, 4 or 5%, sometimes even 8% of the money. It's oftentimes better to have the cash on hand than it is to borrow that 8%. Now, if you've got a way to take that cash on hand and get more than 8% from that, or get 2 or 3 percentage points more from your investing activities with that cash than you would pay out in your borrowing activities from that cash, then by all means run your business on credit. But most businesses find that it's better to have a cash reserve on hand. And I typically recommend 3 months worth of operating expenses, depending upon the steadiness of your business. If your business is fairly steady, you may only want to have 1 month or 1.5 months worth of operating expenses on hand because you are going to have some of those nasty surprises. They're going to consume some of that from time to time. So I think it's really valuable to run your business on cash reserves instead of just using a line of credit as your cash reserve. Here's another question that came in. That is, why would I ever want to prepay expenses? Why would I ever want to give out cash in my business before I really had to? And there are a couple of good reasons to do that. Number one is you might just have a supplier that's in a little bit of a cash flow crunch, and you do that as a favor to your supplier or to build up vendor equity with your supplier. So I've had an occasional supplier come to me and says, hey, can you pay me in advance for the services that I'm going to provide next month or for the products that I'm going to provide next month? Because I'm having a little bit of a cash flow crunch. And depending upon the relationship that I have with him or her, sometimes I'm very willing to oblige that I prepay expenses just to maintain the great relationship that I have with my supplier. Another good reason is for a discount. So occasionally a supplier may come to you and say, hey, how would you like to purchase a 90-day supply instead of a 30-day supply? And when you do, I'll give you a 5 or a 10% discount on those purchases. That's a great reason to do it if you've got the extra cash to go ahead and prepay those expenses or pre-purchase those products that you're going to consume because you're going to be able to get them for a lower dollar amount than you could if you paid for them at the regularly scheduled time. And another common reason to prepay expenses is at the end of the year. It's very common in the last week of December to prepay some of the expenses that you might normally have in January and February to increase the expenses for December, reduce the overall profitability for the year, and reduce the tax liability that you might have for those years. So those are three pretty good reasons for prepaying expenses for your company. And here's one final question. Can you talk again about how you can be profitable on paper but lose money? Well, I might invite you to watch this webinar again so that you can see all of the ways that you can consume cash without actually having it reflected on the income statement. You can buy fixed assets, you can increase accounts receivable, you can decrease your accounts payable or notes payable, you can borrow money to increase cash. There's all kinds of ways that you can generate cash and consume cash with your company that are not reflected in the profitability of the income statement. That's been our presentation for today. Thank you for your kind attention with our presentation on cash flow secrets. We hope that this was helpful to you. And if there's anything we can do at VetHelpVet to help you be more successful in your business, please reach out to us. This is Paul Hoyt. Goodbye.